With me now is Charlie Bobrinskoy. He's vice chairman of Ariel Investments. It's great to see you again, Charlie. And let's start with why you don't put a lot into this CPI number.
Well, I don't put a lot of weight on the CPI number because it's a lagging indicator. Unfortunately, the Fed puts a lot of weight on that same number. So the Fed is behind here in measuring inflation. When they try to figure out rent inflation, you know how they get the data for that? They call people up on the phone and they say, what could you rent your house for? That's a terrible way to measure rents. Actual rents are declining, but the Fed measure still has rents increasing. So the Fed thinks that inflation is higher than it actually is. The good news is eventually their data is going to catch up with reality. That's going to happen sometime over the next couple of months, and they will realize that inflation is not going back to 2%, but it's going to be something like 3 to 4% this year. And that is as reasonable as we can get to after the Fed messed up and flooded the market with money back 2 years ago. So the good news is that we're not going to get to 2% in the short run, but we are moving in the right direction. And even the Fed is going to realize that over the next couple of months.
Do you think they're likely to? So as of yesterday, Charlie, the market odds for a quarter-point hike at the next meeting were 70%. I mean, that's pretty high. What do you think would happen if they hiked again here?
Well, I think they're likely to increase one more time at 25 basis points and then realize, I think they don't want to show panic. I think they don't want to show over concern about the banking system. And so they're going to one more time raise rates one more time. And then I think they could easily be done. I think there's lots of evidence that bank lending is getting dangerously tight. I think there's lots of evidence that the banking system had significant withdrawals from its deposit base, and the Fed is not naive enough to not realize that that's a serious danger. So the most likely scenario, this is one time where I think the market is getting it right, is one more increase in rates and then holding there and then slightly reducing rates in the back half of the year. And that sets up pretty well for the economy, pretty well for the stock market.
I hope so, but it looks like a lot of this is already sealed. You know, when you see the leading indicators turning over and credit crunch, maybe you're right. And but even jobless claims are starting to head north a little bit. They can't stay as low as they are forever.
Well, we're still having pretty decent job growth. We have record low unemployment. We have that employment spread out over lots of the economy, different demographic groups. So the consumer is 70% of the U.S. economy. The consumer is in pretty good shape right now. And most important, Kelly, a lot of the cyclical stocks, you say this is all baked into the market, but cyclical stocks, it's not baked into the market. The cyclical stocks are acting like we're going to have a recession, maybe even a pretty severe one.
That's what I mean. So in other words, what's baked in, the recession to me almost seems baked in. You know, the leading indicators are acting like it. The cyclicals are acting like it. So sure, you could say, I don't think that's going to happen and I'm going to buy the cyclicals here. But you'd be going against, what looks like the weight of history and the plain evidence in front of our eyes.
Well, but the weight of history says the way to make money in the market is to buy what others are selling and sell what others are buying. And right now that is set up for cyclicals, because you're absolutely right. The market is acting like a recession is very probable and maybe even a severe one. And sure, I would say it's 50-50 of whether we're going to have a recession at all. But we will get through this. But the point is that the names right now that are expensive are defensive names, technology names that are viewed as being less tied to the economy, whereas what's cheap is what's performing well today, by the way. So names like Mohawk that I talk to you about all the time, Borg Warner, the automotive supplier, and Apache in the oil industry. Those are names that are trading for less than 10 times earnings because people are worried about a recession. And if we don't get one, they're going to do very, very well.